Okay, you are watching, of course, our live investor event, and my colleague Nadine Blayney spoke to Peter Benson from Credit Connect Group about the difficulty investing in the current macroeconomic climate, given interest rate uncertainty and volatility in markets. Let's take a listen.
Well, it's a very, very volatile market at the moment. Obviously, the share market's a little volatile. Obviously, the market that we play in is also a little bit volatile. So basically, what we're suggesting with rates maybe going up, maybe going down, no one really knows. What we're really doing for our investors in our fund is we're only investing probably for 12 or a maximum 18-month terms, so they're not locked into longer terms on returns because no one really knows what they're going to do. So how we're countering that is simply by putting funds or our clients' funds into investments for 12 or maybe 18-month terms.
Okay, so I think I did get ahead of myself there because let's take a step back. That's the scene setter. Just tell us about Credit Connect Group and what it is that you actually do.
Well, obviously, with my grey hair, I've been doing this a long, long time. Me personally, I've been doing this since 1992, so I don't know what the maths is, but it's over 30 years. So basically, I've just dealt in the private mortgage market, private lending market, non-bank lending sector. So we've had basically a borrower, and then we've had an investor or a lender that has lent money, and we've just sat in the middle and managed that. So I am the CEO of the Credit Connect Group, which was formed in 2006, so that's 18 years ago. So we hold an Australian financial services licence, and we basically operate the Credit Connect Select Fund, which offers investors to invest into direct mortgages, and they can get returns typically from 8 to 10% on their money, which is fully secured.
Okay, so let's just break that down a little bit.
Yes.
So who are these borrowers? Who's getting this money?
Well, perfect example, a borrower, your audience, I'm assuming, is quite savvy. So they would have borrowed and probably bought a property years ago or recently, and they probably needed the bank to fund that specific purchase of a property. Typically, our borrowers, for some reason, will need money quickly. They need settlements on properties done quickly and promptly. Approval processes from banks are probably taking 30 to 35 days now. Now, typically on a purchase contract, when you buy a property, you really only have 14 days to get finance approval. So some people are being delayed by banks in getting financing for certain requirements. Perfect example is a lady that lives in my street. She purchased a property for $2 million. She had $1.7 million in a term deposit. I won't say which bank, but let's just say their logo is blue and white. Top 4 bank, and she wanted to borrow $500,000 to purchase that house. And that bank, over a 60-day period, finally said no. So she had a deposit paid to purchase that house, a 10% deposit, which is $200,000. So she was in a difficult position where she could potentially lose that deposit. So she then had to come to an alternate, a non-bank lender like ourselves, to provide what we call a bridging loan to settle that purchase for her.
Okay, and so do you also deal with property developers? Like, what is the typical sort of investment that people into the fund can make?
We have an array. So we've got developers that we lend to. I have one development group that we lend to. I won't tell you their development figures, but it's staggeringly high. So we have high-end developers. We probably have 3 or 5 high-class developers that we lend to, which are significant amounts of money that we lend. We have first-time developers, mum and dads, maybe doing a little duplex, doing smaller developments. We lend on residential properties. We lend on land subdivisions. We lend on childcare centres. We lend on commercial properties, unit banking or residential holdings also. So there's an array of loans that we actually raise funding for our investors to invest into.
And so what is the process in vetting those borrowers?
Yep. So basically, we have a lending process or a lending manual. First and foremost, we have BDMs. Now, what a BDM is someone that's out there basically for us finding borrowers. And typically that's from a finance broker. So we've got a hive, if you like, of finance brokers that our BDMs in Sydney, Melbourne and our Queensland office on a daily basis will contact them, and they will approach us for a loan. If a loan meets our lending metrics, it's then submitted to our lending committee. As I said earlier, we have a lending manual. So if the loan then meets our lending manual, terms are actually approved to that borrower, and that property then has to be valued by our panel valuers. So there's quite a large vetting process that we do to actually approve our loans before our investors actually see the lending opportunities.
So these aren't necessarily riskier loans than what the major banks are doing?
No, a lot of people don't really understand the non-bank lending sector. Any loan that we do, there's always a risk. No one can sit here and say there is no risk, but there is we try to minimise the risk as the manager. Typically, we're only lending to 65 to 70% to the value of the property. So there's always 30 or 35% worth of equity in the property. So the market would have to turn significantly for that investment or that mortgage to be exposed.
And when people are on the other end of the equation, putting money into this fund, how does that work? Can they choose specific developments perhaps that they would prefer to lend to, or what's the term of these investments?
So we hold, as I said earlier, we hold an AFSL license. So we operate what we call the Credit Connect Select Fund. There's really two mortgage funds that are in existence, if that's the right word. There's a pooled fund where the manager will basically take your funds, which you've invested, into a deposit, and you don't really specifically know where your money's gone because that manager has the discretion, similar to a bank term deposit, if that's the right word. So the bank takes the money and they lend it wherever they lend it.
Yeah.
We are completely opposite to that. We operate what we call a contributory fund, and we tell investors specifically, here is that loan. That example I said earlier, here was this lady, she bought a $2 million property, and we were lending $500,000 on that property. So the investor knows specifically your money is going into that specific loan, which gives them the opportunity to do their own due diligence if they want.
Okay, so this is very transparent. How would one go about finding out what sort of opportunities are on offer?
Well, as I said earlier, I'm not being arrogant. I have been in this business a long time, and I've just sort of noticed since COVID, transparent now seems to be the buzz investment word. But that's all we've ever done. It's a transparent investment. So we're going to tell the investors, this is where your money's being invested, and we give them the opportunity to undertake all of their own due diligence if they want, bearing in mind we've actually done all of that prior to them seeing our investment offer documents.
But what types of returns typically do your clients see or achieve, on a monthly basis?
I know your audience is very share-driven, share-orientated, so I know I can't past performance, I can't guarantee the future performance. A statistic shows in the calendar year for 23, the ASX top 200, I think from memory, returned 7.7%. Our Credit Connect Select Fund, for the same period of time, actually returned 9.4%.
Okay, so that's interesting. And if one was to invest, we do need to talk about the risks. There is the risk that the market could change. There is a risk that one of these investors could default. What is the liquidity risk?
There is definitely a risk. There's a risk when you cross the road. There's a risk when you invest in a share, and there's definitely a risk if you invest into one of our mortgages. What the risk is if the borrower defaults, they obviously, what that means in layman's terms, they don't meet their interest payments. So we hold security via a mortgage on the property. So that then allows us to take possession to that property and sell that property up to recoup the capital that we've invested. Now, as I said earlier, we're only typically lending to 65% to the value of the property. All the loans that we do, very, very similar to a bank. We have our own panel valuers. We have used our own panel valuers for up to some valuers we've had on our panel for 20 or 25 years. So a valuer will establish independently a value of the property, and we're only lending to 65% to the value of the property. So for a risk to be exposed, when we sell the property, the market would actually have to turn more than 35% for the investors' funds to be exposed to a loss.
Is there high demand for this service? I mean, is it the funds, gathering the funds to fulfill the needs of borrowers? Is that the challenge, or is it the opposite?
As I said, I've been doing this for 30 years, and each year there are more and more new players coming into the market. There's a statistic only, I think, late last year or early this year, I can't remember who wrote the commentary. Non-bank lending is currently in Australia at a 74 billion peak, and they propose that will actually double in the next 5 years. So there's definitely a need, and there's a growing need for non-bank lenders. The reason I'm here today, a lot of people don't know about investing into a mortgage fund or that sort of platform, and that's why I'm here today to say, hey, there are other investing opportunities that will probably give you a higher return than the ASX 200, and B, will give you monthly interest payments opposed to waiting for an annual dividend.
Okay, so again, the property market is so varied across Australia. Like, what's really hot right now? Where are you seeing a lot of the deal flow coming from?
Well, as I said, we've got BDMs all over Australia. So we have lending opportunities all over Australia. So if you're based in Perth, we've got lending opportunities currently in Perth. But typically the markets that the majority of our loans are written are in Sydney and Melbourne. That's where obviously larger populations, larger markets. So that's the majority of loans that we write are in the Sydney and Melbourne